the daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management,
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Hold your calls, because on our guest line is Dr. Simon Johnson. He is a Ronald A. Kurtz Professor of Entrepreneurship at MIT Sloan School of Management and author of the book 13 Bankers, The Wall Street Takeover and the Next Meltdown. It's interesting, with all the news coming out about Goldman Sachs and all the stuff that we're hearing right now. Dr. Johnson formerly served as an economic counselor and the director of research at the IMF and is currently senior fellow at the Peterson Institute of International Finance, contributor to the New York Times, and business editor for the Huffington Post. Dr. Johnson, welcome to Market Wrap.
Thanks for having me.
Dr. Johnson, let's talk about how this financial crisis started, because everyone has a different view of where the problems really began. Where do you believe the beginnings were?
Well, the beginnings go back a long way. They really go back to the deregulation of banking in the late 1970s, which picked up speed with the Reagan Revolution in the 80s and really took hold somewhat permanently when Robert Rubin and the Wall Street wing of the Democratic Party rose to ascendance in the mid-late 1990s. So this is bipartisan. Everybody bought into the idea that finance was good, unregulated finance was better, and unfettered megabanks were the best.
There's a section in your book called Not Enough Lifeboats. Can we liken this to the Titanic, where it seemed as if conscious decisions were made about who was going to be saved and who was going to be lost?
Yes, absolutely. I think, the Titanic, how that was handled in the Titanic is obviously a different topic and somewhat controversial, but in this case, there was a decision made, or a series of decisions made to save the biggest banks without imposing any losses or adverse effects on their management or their boards of directors or their creditors, and you can argue about how the impacts were on their shareholders. This was an extraordinary and I think overly generous bailout.
Talking about not enough lifeboats, do you think it was a conscious decision was made to let Lehman Brothers fail? Certain companies were picked to say, okay, these we will let go, we'll let these fail and bear Stearns, and these other ones we are going to save.
Ex post, yes, that is how it looks. I was working on these issues when I was chief economist of the IMF through August of 2008, and then we were working and following these issues very closely, because we set up our blog on the global economy baseline scenario. I think it was much more chaotic and much less planned. And in fact, part of the problem was that Treasurer under Hank Paulson had absolutely refused to come to grips with the fact that we were entering a phase of very serious financial turmoil.
So as far as this is concerned, Dr. Johnson, do you think that was there an intent? Was this intentionally done, or was just chaotic and nobody knew anything to do and say, okay, let's pick this one? It's like in a war, there are casualties. And was that the case, or was this something that was there was malice involved in this?
No, well, it certainly wasn't malice. There's no conspiracy here. It's a system of incentives and beliefs in and around the most powerful firms on Wall Street that's fundamentally dangerous to the financial health of this country and the world. And part of that system is the extreme reluctance on the part of the previous administration and this administration to face up to the reality. So Herb Allison, very very distinguished, successful Wall Street executive who now works for the Obama Treasury Department, said on Capitol Hill not too long ago, there is no too big to fail policy on the part of this administration, meaning they wouldn't say the too big to fail banks if they failed. Well, of course they would save them. I mean, that is the most stupid statement you can possibly make in this situation. To deny the reality is to fail to confront the policy choices that need to be made. I'm not saying anything is easy in this situation, and I'm not saying that you need precipitate action that would tip anybody closer towards creating systemic risk.
Dr. Johnson, let's move a little bit farther and talk about too big to fail. You just mentioned that. There's been a lot of talk about that right now, especially with the new financial regulatory reform. Do you think the reform goes far enough, and is there a provision in there that will let these banks which are too big, will they be allowed to fail?
Well, the Dodd bill moves things in the right direction, not enough in our view, and the key issue is how you would resolve or manage the failure of the largest banks. Now, I would stress that the position taken by Senator Mitch McConnell, the Republican leader in the Senate, is completely at odds with reality. He says that the Dodd bill creates a new bailout fund and will perpetuate bailouts. That's absolutely not true. The question is whether it, if as effectively as possible, extends an FDIC-type resolution mechanism to our biggest, most complex cross-border financial institutions. I mean, nobody says the FDIC runs bailouts. The FDIC protects insured depositors, generally wipes out shareholders, fires the management, of course, unceremoniously, and generally speaking, actually also imposes losses on uninsured, unsecured creditors.
Do you think these institutions, Dr. Johnson, have gotten too large as is right now, and they should be broken up into smaller pieces where it doesn't affect the whole, and as that does not affect the entire economy?
Yes, that's exactly my view, and you put it very well. Look, the largest financial institution we let fail and go through a standard debt restructuring last year in the United States was CIT Group. It had a balance sheet of about $80 billion total assets, 80.
Right.
The big banks, I mean, Goldman Sachs, for example, fluctuates around $800 billion total assets, 10 times bigger. There's no way you would have Goldman Sachs fail or wanted to go through bankruptcy if it hit a rock. I guess it did hit a rock, but probably not that kind of rock. There is no evidence of economies of scale or scope or any other benefits to society from having banks bigger than $100 billion total assets.
Dr. Johnson, let's talk a little bit about the next financial meltdown. Where and when do you see that occurring?
The when is, of course, the hardest question of all, and I think I'll punt on that. But the where, I think, is clear, that the largest banks we currently have with this too-big-to-fail attitude and reality have cheaper access to funding. They have an incentive to take risk, and they get the upside. Downside is someone else's issue, largely.
Dr. Johnson, let's talk a little bit about, you're talking about emerging markets and developed markets, and right now we're seeing some of the debt of the developed world sort of to come unhinged, like what we're seeing out of the pigs, Portugal, Ireland, Greece, and Spain. Is this the beginning of something that is trying to tell us that the debt problem in the developed world is getting out of hand?
Well, the Eurozone has a problem, a very big problem, and I think that's what the situation in Greece tells us, and there are warning signs around Portugal, and I have to say, when we've tried to bring this to the people's attention in Portugal, the response has been extremely negative, which of course only worries us further.
Dr. Johnson, let's talk a little bit about how the sort of world is upside down right now. We used to have the IMF go in and put very stringent regulations and demands on the emerging market countries that were overspending, their budget deficits were too large. You wanted them to cut their subsidies, cut all the help that they were doing. Now that Greece is going to the IMF, or some way they will get some money from Europe, do you think the IMF is going to impose the same kind of restrictions that it used to impose on the emerging markets, on Greece and other Eurozone countries that borrow from the IMF?
No. I think the IMF is actually going to err on the side of being too lax, actually, for various reasons. And, you know...
What are those
they're
reasons?
in a very difficult position.
Why would they do it differently for Europe than they did it for emerging markets? Because the people in those countries went through some immense pain when these measures were imposed on them.
Yes, well, the real reason is that Dominique Strauss-Kahn, the managing director of the IMF, is running for the presidency of France, and most of what the IMF does at this point at the high level
political
public awareness that we're talking about is with an eye to getting Mr. Strauss-Kahn elected. It's quite extraordinary and bizarre. In a general election head-to-head with Mr. Sarkozy today, Strauss-Kahn would probably win, but he needs to capture the socialist nomination first. So there is no appetite of the IMF for taking even sensible measures of fiscal austerity. And I have to say that what we're recommending includes some fiscal austerity, more than screwing the cards. We're also recommending debt restructuring for Greece and potentially moving the exchange rate as well. We're also recommending debt restructuring very much along the lines of what you would be considering if Greece were an emerging market. And, you know, I think quite soon people will be talking sensibly and constructively of Greece as an emerging market. Emerging markets can have crises, they can bounce back. The danger for Greece is they go down and they stay down because they're locked into this European structure and Euro structure that is not entirely appropriate for these circumstances.
That is Dr. Simon Johnson. He's a professor at MIT. Great book, 13 Bankers, The Wall Street Takeover, and the Next Meltdown.